Hello, everybody. It's Tortoise Investing coming at you today with another 5 dividend stocks that you can buy and hold forever. After this, if you get a chance, make sure to check out the stock analysis of the Cigna Healthcare Group. I just uploaded that as well. Today's going to be a double upload day. I like putting together these buy and hold forever videos, and Yins like them, so win-win. If you're new, make sure to hit that like and that subscribe button. Join me so you don't miss out on any future videos. And without further ado, let's go ahead and dive into it. Today we're going to be taking a look at Domino's Pizza, Union Pacific Corporation, Rowe Price, Bank of America, and Realty Income. Now let's roll off now with some Domino's. Domino's with an adjusted free cash flow of 3.13%, a dividend yield of 1.42%, and a payout ratio of 34.8%. A nice low payout ratio. And Domino's is a good grower in my eyes. I like this company a lot. So let's take a look at the prices over the last 5 years. So it looks like back in 2021, it cracked over $550, and as well as a lot of things have done, it is down. It's down almost $200 off its high. And it is still trucking along with its revenue. The free cash flow is still great. EPS, everything looks good still with this company, and I like it a lot. So let's take a look here over the last 5 years. Been increasing at a rate of 10.23% with its revenue. The free cash flow has been increasing at a rate of 9.28%. Looks like they had a little dip there. They buy back shares like crazy. It's one thing I really like about Domino's. So over the last 5 years, EPS has also been increasing at a rate of 14.34%. They do carry quite a little bit of debt. They've got 4.93 billion in debt. Looks like they're paying it back a little bit. That is quite a bit more than their EBITDA, but this company and Union Pacific Railroad as well, they use debt to buy back shares, and I'm okay with that. They've been doing it for a while, and they seem like they know what they're doing. They got things under control. They got good profit margins on everything, so I don't view that as a concern. So the dividend has been increasing at a rate of 17% over the last 5 years. Very nice. And like I said, the shares outstanding, they buy back shares like crazy. Over the last 5 years, been decreasing at a rate of 5.41%. That is awesome for a company this big. And especially right now where they're down off their recent highs of like 550, right now more than ever, I want them to be buying back shares. And they are. The return on capital employed is ridiculous. 60, 70%. Very high. A very big moat. Because I think when it comes to pizza companies, pizza delivery companies, there's two that come to mind. That's Domino's, that's Papa John's. And I feel like Domino's is the main leader. They've been getting some like EV cars for their delivery fleet. So, I mean, there's a lot of things ticking with this company that I really, really like a lot. Now, next up, we got Union Pacific. Now, if you're looking for an industrial, I mean, you can't go wrong here. This is probably the railroad company in my eyes. They got an adjusted free cash flow yield of 4.33%. They got a dividend yield of 2.56% and a payout ratio of 45.9%. So, again, no worries whatsoever there. With their revenue, kind of hovering around the 20 billion mark, 25 now. It's been up and to the right. Over the last 2 years, it has been increasing at a rate of 12.85%, so you do want to see that going up. It's not a rapid increase, but their free cash flow is going up pretty quickly. Over the last 5 years, at a rate of 7.54%, so you do like to see that. EPS been increasing at a rate of 10.42% over the last 10 years. The reason this is there is because they had that spike in 2017. So we're going to look at the 10 years, kind of the average. But again, up and to the right, like to see it. Again, they carry quite a bit of debt. They have $31.65 billion in debt. That still falls in range of my 3-time rule that I like to try and keep with my EBITDA. Try to keep my debt no more than 3 times my EBITDA. But again, they use debt to do buybacks on their shares. So their dividend has been increasing at a rate of 12.23% over the last 5 years. A good, strong compounder. Like to see it. There you go. Look, share buybacks. Same thing with Domino's. Almost 5% over the last 5 years. I like to see it, and they're buying back cheap shares because if you take a look at the price here over the last year, they touched 241, and they've been higher than that in the last 5 years. Yeah, back in 2022, $273. So they are down to 205. That's about $65 off of their recent highs. So they are definitely taking advantage of that and buying back more shares, which you like to see. And the return on capital employed is slowly growing. Currently at a rate of 16.55%. So very nice. I like it. I like it as a industrial, and I think it is the railroad company in my eyes. Next up, T. Rowe Price. T. Rowe Price is having a heck of a day, but I still think it's a good deal. Nothing in today's video is financial advice. I'm not telling you to go out and buy these, just trying to show you something that might catch your eye and you might like. But yeah, T. Rowe Price got adjusted free cash flow yield of 4.85%, have a dividend yield of 4.39%. Payout ratio a little bit high at 79%, but that's not an issue. T. Rowe Price knows what they're doing. So the revenue has been increasing at a rate of 7.94% over the last 10 years. Very nice. Again, up and to the right, you like to see it. Their free cash flow has been increasing at a rate of around 9.37% over the last 10 years. Again, up and to the right, you have these little dip downs here. And let's take a look here at EPS. Again, 6.85% over the last 10 years. They did have the little 2022, and they're having a little bit of a hiccup again this year because there was a technical recession last year, and there's a lot of recessionary fears for this year. But once things get back in order, it's going to be right back off to the races. I really like T. Rowe Price, and the reason being is they don't have any debt. They don't carry debt. They carry cash, carry oodles and oodles of cash. I like it, especially if there's going to be issues, if there's going to be like a recessionary environment happening. You want companies that carry low debt or companies that have carried debt through financial crisis, cough, cough, '08, and like 2017 area, I believe, was when a lot of companies were having issues, and know how to make it through it. And I feel like a lot of these know what they're doing. The dividend with T. Rowe's been increasing at a rate of 12% over the last 10 years. Their recent hike was a small one at 1.6% from $1.20 to $1.22. But again, whenever they need to, they do like smaller hikes, and then they got these bigger ones in here when things are, taking off. And they occasionally do a special dividend here and there. The last one was back in 2021. So, I mean, I like T. Rowe. I think it's a great buy and hold, and just like add on opportunities when things, are down. Share buybacks, they're doing them slowly at a rate of 1.5% over the last 5 years. I'd like to see them do more share buybacks, but I mean, I don't own a company. I don't know what they're doing. I know that their financial sheet's amazing. Return on capital employed has been 18, 20, 20. Yeah, this is also going up. I'd like to see that. Again, they had the little dip in 2022 and probably this year because of the issues that are going on with the market and all that. But T. Rowe Price, I like it as a financial stock. You get a good, hefty dividend yield and a really safe and secure company in my eyes. Next up, the bank stock. Bank of America, they got an adjusted free cash flow yield of 10.71%. They got a dividend yield of 3.08% and a payout ratio of 26%. Nice and low. And they recently announced a dividend increase, I think, of 9% on top of everything. So their revenue, slow and steady over the last 2 years, been increasing at a rate of 5.36%. Their adjusted free cash flow is kind of all over the place. EPS increasing at a rate of 14.73% over the last 5 years. It's a nice little up and to the right going on there. They got more cash than debt on hand. Love to see it. And when it comes to the dividend's been increasing at a rate of 12.89% over the last 5 years. So a nice, strong compounder in Bank of America, and it is down pretty heavily off of its highs. Let's see where it was even a year ago. Yeah, it looks like it was around 28 back in November, and now it is down to 20. It was at 38. It's now down to 28, so it's down about $10 off its recent highs. And again, if you need a bank stock, I feel like this might be one of the safest ones out there. Again, personal opinion, but I like Bank of America. And when it comes to their share count, their shares have been decreasing at a rate of 4.51% over the last 5 years. It looks like here they have halted their share buybacks, but maybe they'll start that again, especially since they're down recently. Who knows? I think it would be a great idea for them. I like when companies do share buybacks. I'd almost rather them do share buybacks than dividend increases, but again, just me, just my personal opinion. And next up, the monthly dividend company, Realty Income. This is a REIT. REITs are taxed differently, just to let you know. This is something that you'll have to look up for yourself, but yeah, these are taxed. I think as usual as ordinary income. So make sure to. There's some charts online that you can look up to see what your tax rate would be. But if you need some real estate, you can't go wrong with Realty Income. Got just a free cash flow yield of 7%, a dividend yield of 5.15%. We don't pay that payout ratio any attention because when it comes to these, you look at the FFO. You don't look at the payout ratio. Now, the revenue's been increasing at a rate of ridiculousness over the last 10 years. It is just up and to the right. The free cash flow has been increasing very quickly as well in the 20 percentile. And the dividend has been increasing forever and a day. And the thing with this company is they do little hikes every quarter. I don't know if that'll show up here. They do like little dividend jumps every quarter, and then once a year they give you like a 3 to 4%er, and it kind of evens out in the long run. Over the last 5 years, been increasing that rate of 3.73%. So another really, it's a good dividend yield. I feel with Realty Income, anytime this is above 5%, that the company's on a pretty decent sale. This is the old reliable. I think I've been increasing their dividend for like 27 years or something like that. It's one of the very few REITs that are in the 20 years section when it comes to dividend increases. But yeah, that is the 5 stonks we're taking a look at today. You can buy and hold forever. If you got any questions, or just let me know down below in the comment section. Make sure to hit that like and subscribe button before you leave. And until next time, see yous.